Stop scrolling. What I'm about to tell you in the next few minutes could literally save you thousands of dollars. And if you're a senior homeowner in America right now, ignoring this could cost you more than you've ever lost at one time in your life. There is an IRS deadline coming in 2026 that most seniors have never heard of, and the silence around it is not accidental. Stay with me, because by the end of this video, you will know exactly what this deadline is, who it affects, what happens if you miss it, and most importantly, the specific steps you can take right now to protect yourself completely. Welcome to Seniors Benefit Blast, the channel that does the research so you don't have to. If you're new here, hit that subscribe button right now because we publish content like this every single week. Content that your financial advisor, your bank, and sometimes even your accountant won't bring up unless you ask the exact right question. And today's topic, most people are not asking. That's exactly why we are. Let's get into it. And I promise, this is not the typical tax video. What's happening right now with the IRS and senior homeowners is genuinely different from anything we've covered before. And the reason it matters so much in 2026 specifically comes down to a combination of changes that all collided at the exact wrong time for retirees sitting on real estate. Here's the backdrop. Home values across the United States surged dramatically over the last several years. Even seniors who have lived in the same house for 20 or 30 years are now sitting on properties worth 2, 3, sometimes 4 times what they originally paid. On the surface, that sounds like wonderful news, and in some ways it is. But what the IRS sees when they look at that situation is a taxable event waiting to happen. And if you are not structured correctly before their 2026 deadline, you could owe a sum of money that would genuinely shock you. Now here's the piece most people miss entirely. There is a long-standing provision in the tax code that allows homeowners to exclude a significant portion of capital gains when they sell their primary residence. A married couple filing jointly can historically exclude up to $500,000 in profit. A single filer can exclude up to $250,000. Most seniors know that rule exists. What they don't know is the condition that rule depends on. And that condition has a deadline attached to it in 2026 that is not getting nearly enough attention in mainstream media. The condition is called the ownership and use test. To qualify for that exclusion, you must have owned the home and lived in it as your primary residence for at least 2 of the last 5 years before the sale. That sounds simple, and for most people who bought their home and never moved, it is. But here's where the trap opens up, and it's a trap that is catching seniors in record numbers right now. If you moved out of your home at some point to assist a family member, to enter assisted living temporarily, to spend extended time with grandchildren, or even to try out a different state for retirement, your 2-year clock may have been interrupted. And if you are now planning to sell that home, or if health circumstances force a sale in 2026 or beyond, and you don't reestablish your primary residency status before the IRS threshold window closes, that entire $500,000 exclusion could disappear. What's left behind is a capital gains tax bill that the IRS will collect without apology. Let me give you a real scenario so this lands with full weight. Picture a 73-year-old widow in Florida. She owned her home for 22 years. Her daughter needed help after surgery, so she stayed with her daughter across the state for 14 months. She came back home, but then entered a short-term rehab facility for 4 months after a fall. She's back home now. She plans to sell in early 2026 to move closer to family. When her accountant runs the numbers, they discover her qualifying residency periods over the last 5 years add up to just under the 2-year threshold. The result? She loses her capital gains exclusion entirely. On a home that appreciated by $600,000, she owes capital gains tax on the full amount above the exclusion, a bill that could reach 6 figures. That is not a hypothetical. That is the pattern we are seeing repeat itself across the country right now. So what do? First, calculate your residency timeline immediately. Go back 5 years from your anticipated sale date and map out every period where you were not living in the home as your primary residence. Count the days honestly. If you are close to the 2-year threshold but not quite there, you may still have time to reestablish residency and satisfy the test before you sell. This is where a few months of deliberate planning can save you enormous sums of money. Second, understand the exceptions. The IRS does provide hardship exceptions for specific health-related circumstances and for certain situations involving disability or the need for long-term care. These exceptions are narrow, they are documented, and they require you to meet a very specific standard, but they exist, and many seniors who qualify never claim them simply because they didn't know they were available. Work with a tax professional who specializes in senior real estate situations, not a general accountant, to evaluate whether any exception applies to you. Third, if you have adult children or family members who may one day inherit your home, share this video with them today, because the 2026 changes also carry implications for inherited property and the step-up in basis rules that have protected families for generations. There are proposals and regulatory adjustments circling that topic right now, and the families who are ahead of the deadline will have options. The families who find out after the fact will not. Here at Seniors Benefit Blast, our entire mission is to make sure you are never in that second group. You have worked your entire life to build what you have. You have paid taxes faithfully for decades. You deserve to keep what is rightfully yours. And the only way to do that in 2026 is to move before the clock runs out, not after. If this video helped you understand something you didn't know this morning, do one thing right now. Hit the like button. It takes 1 second. It costs you nothing. And it tells YouTube that this information is important so we can reach more seniors who need it. Then drop a comment below. Tell us your state, and tell us whether you've already talked to a tax advisor about your home sale plans. We read every comment, and we use your questions to build future videos on this channel. And if you are not yet subscribed to Seniors Benefit Blast, now is the moment. We are putting out new content every week on IRS updates, senior benefits, Social Security changes, Medicare deadlines, and every financial shift that directly affects your retirement. Subscribe and hit the bell so you never miss a deadline again. Because in 2026, what you know, and when you know it, is the difference between protecting your wealth and losing it. Don't let that happen to you. We'll see you in the next one.